So it is almost exactly 2 months ago that I provided our last update. Back then I was talking about the conflict in Ukraine and the growing issue with inflation. Here we are now, and these same two topics are still dominating the headlines. So far this year, both bonds and equities have seen quite strong falls. So for example, bonds are down about 10%, US equities are down about 15%, and even the tech heavy Nasdaq's down around 25%. Although actually it's reassuring to see that the UK market has been largely flat so far on the year. And it's almost as if we've been seeing a bit more panic selling in the last few days. So what have we been doing in our latest rebalance? Well, first of all, we're buying back into corporate bonds. I highlighted in our last video in March that we'd sold them on a tactical basis due to our concerns on inflation, but we're now rebuilding our exposure. And this is going to be split between short-dated, high-quality UK corporate bonds with yields now over 3%, and also short-dated, high-yield US corporates with yields now over 6%. So we are remaining underweight our central position, but we feel that probably quite a bit of the bad news about inflation is beginning to get priced into markets, and so that's the time we want to start going back into that market when there's a lot of there has been a lot of selling and almost some fear in that sector. And also then for our lower and medium risk portfolios, we're using some of the cash we have to top up on equities, mainly in the US. For our higher risk portfolios, we're already fully invested, so there's no further changes being made there. And then finally, for our medium and high risk portfolios, we're adding a commodities fund for the first time to take advantage of where we see some opportunities, particularly around energy and mining. So where does that leave us? Well, we started playing the inflation theme over 2 years ago, and I think in hindsight we were too early. As the COVID pandemic saw growth funds continue to outperform strongly. But we stuck to our approach and continue to gradually add to this inflation theme with more cyclical and value funds. And these really have been the key driver of our very strong performance relative to most of our peers in the last 6 to 12 months. Now, I'd say that our portfolios are quite nicely balanced. We've got a blend of growth funds looking for opportunities in technology, in industrials and healthcare. And we've also got several more of these cyclical or value funds with their focus on energy and mining. And these continue to look cheap and also offer some very attractive yields. So I think just in conclusion, even though we're all facing worries around inflation, rising interest rates, or the conflict in Ukraine, and these could certainly carry on for a while, and it's definitely impacting markets. I think we should remember that some of the more stabilizing factors, which are still at play in the economy. So we have steady, even rising house prices. We've got low unemployment, and we've also got generally high savings rates. And this is why we're taking advantage of the current weakness in bonds and equities to buy back into these areas which we had previously sold. And also just topping up into areas where we expect to see continued growth once the current uncertainties start to lift. Please get in touch with your usual contact if you'd like more information, but for now, that's all from me. Thank you.